Picture this. You finally close on your absolute dream home, but after you sign that mountain of paperwork, your name isn't actually on the deed. Or, you buy a brand new car, you drive it right off the lot, but the official registration, totally in someone else's name. Sounds pretty alarming, right? You'd probably be on the phone with your lawyer in seconds. Well, if you hold stocks in a retirement account or use a day trading app, there is a super high chance your name is literally nowhere to be found on the company's official books. Welcome to this explainer, where we're going to unpack a completely counterintuitive reality of global finance.
So it brings us to a beautifully simple question. Who really owns your stock? I mean, it totally challenges our basic assumptions about what it means to actually own something in today's world. You bought the shares with your hard-earned cash, you log in, and you see them sitting right there in your account. But in the eyes of the law, who actually owns them?
Okay, let's dive into this. The fact that your name isn't on the company books, it's not a mistake, and it is definitely not a scam. It's actually a multi-trillion-dollar standard. This split in ownership is quite literally the hidden plumbing that makes our modern markets work. It allows massive, massive volumes of capital to zip across the globe every single day without a single physical piece of paper ever changing hands. Honestly, without this system, the fast-paced trading environment we completely take for granted would just grind to an immediate halt.
So here's our roadmap for today as we peek under the hood of this incredible global financial system. We're going to cover 1. The illusion of ownership, 2. The personal assistant analogy, 3. Flags of convenience, 4. Omnibus versus segregated accounts, 5. The voting rights trade-off, and finally 6. The daily reconciliation challenge.
All right, starting off with Section 1, the illusion of ownership. In the incredibly complex world of large portfolios and global trading, the person holding the asset and the person enjoying the asset are almost never the same person. We basically operate on a two-part framework. On one side, you have legal ownership. Now, this refers strictly to the entity whose name is recorded on the official share register. That's the legal owner, full stop. But on the flip side, you have beneficial ownership. The beneficial owner is the actual underlying investor. That's you. The person who supplied the capital, took on the risk, and gets to enjoy all the fruit of the investment, meaning you get the cash from dividends and you keep the capital gains when that stock goes up.
Let's move to Section 2, the personal assistant analogy.
To really ground this kind of abstract idea, imagine you have this highly trusted, super discreet professional personal assistant. Let's say you want to buy a rare painting at a high-end auction, but you really, really don't want to deal with the mountain of legal paperwork, the shipping logistics, or having your name splashed all over the news as the buyer. So you just give your assistant the cash. They go to the auction for you, they sign the purchase contracts in their own name, and they lock the art in a secure vault that they manage. Legally speaking, the auction house and the insurance folks, they see your assistant as the sole owner. They're the ones holding the title. But let's look at the other side of that coin. Beneficially, that painting is 100% yours. Even though your name isn't on the official receipt, you are the one who decides when to sell it. And if that painting doubles in value over the next 5 years, you are keeping every single penny of that profit. You control the asset, you reap all the rewards. In this everyday scenario, your assistant takes on all the legal and administrative headaches while you act as the beneficial owner, just enjoying the economic upside.
Which brings us to Section 3, flags of convenience. So, you might be wondering, why on earth would we separate these ownership types on a massive market-wide scale? Well, it all comes down to what we call a nominee company. A nominee is essentially a flag of convenience. It's a specialized legal entity used by banks, brokers, and wealth managers that literally does absolutely nothing except hold titles for other people. They don't have their own trading strategies, they aren't taking risks, they just act as the professional personal assistants of the financial world, shielding you, the beneficial owner, from a ton of administrative nightmares. The real magic word here is operational efficiency. Think about it. If every single retail investor had to have their personal name officially recorded on the register of Apple or Microsoft every time they bought a share, it would be an absolute logistical disaster. We're talking mountains of physical paperwork, verifying signatures, and weeks of waiting just to process one single trade. But because the nominee's name stays perfectly static on the official register, millions of shares can be bought and sold right behind the curtain. The legal ownership never actually moves, so trades can settle almost instantly through secure electronic book entry transfers.
And this whole concept reaches a mind-blowing scale in the US, with a name you will see on almost every single stock register, but I bet most people have never even heard of, Cede Co. Get this, Cede Co is the nominee for the central depository, and incredibly, this one single entity is technically the legal owner of a massive percentage of all U.S. stocks. We're talking trillions and trillions of dollars of value. Everyone else, massive pension funds, day traders, mutual funds, they just hold those assets beneficially through complex layers of banks and brokers, all trickling down from that one giant legal owner. It's kind of wild when you first realize it.
Moving right along to Section 4, Omnibus versus Segregated accounts.
So how do custodians actually keep track of these massive positions behind the scenes? Well, they generally use two different account structures. First up is the omnibus, or pooled account. This is where the holdings of hundreds or even thousands of clients are all commingled together under one single nominee name. It's super cheap and really easy to run, which is why it's so common. But it means the custodian has to keep absolutely flawless internal records to know exactly who owns what in that giant pool. On the other hand, we have the segregated or designated account. This structure gives a highly specific code to a single client, like nominee account 001. Now, this is way more expensive and labor-intensive to run, but the big payoff? Safety. If a major financial institution defaults, it is so much easier to instantly identify and protect your assets if they're strictly segregated from everyone else's.
All right, Section 5, the voting rights trade-off.
So we've talked a lot about the cash, but what about corporate control? There's actually a really high-stakes conflict here in a split ownership system. While the beneficial owner gets all the financial fruit, the dividends, they usually lose the direct automatic right to vote at annual company meetings. Why? Well, because the nominee is the legal owner, whose name is officially on the register. They're the ones formally getting the meeting invite in the mail from the board of directors. The company itself literally doesn't know who the beneficial owners are. So how do you actually exercise your rights as an investor? It basically works in 3 essential steps. Step 1, the nominee gets the official meeting invite. Step 2, since the nominee doesn't actually have an economic stake and really shouldn't be making business decisions, the custodian issues a proxy. Think of this proxy as a legal hall pass that officially transfers that voting right down the chain of custody to you. Step 3, armed with that hall pass, the ultimate beneficial owner can now step up and cast their vote, making sure their voice is actually heard on important corporate matters.
Finally, Section 6, the Daily Reconciliation Challenge. This right here is the operational climax of the whole global market. The one absolute necessity that keeps this entire interconnected system from breaking apart is reconciliation. Every single day, firms have to go through this rigorous, high-stress process to prove that their total legal position held externally at the central depository perfectly matches the sum of all their internal, beneficial client records. It is a massive daily balancing act. If a bank says its clients own exactly 1 million shares of a company, that central depository better show exactly 1 million shares in the bank's nominee account. And guys, the stakes here couldn't possibly be higher. If those two numbers don't balance perfectly at the end of the day, things break down incredibly fast. Someone might miss a critical dividend payment they're legally owed. Or even worse, the exact same share might be accidentally promised to 2 different people, creating this crazy phantom stock scenario. Ultimately, if this daily reconciliation process fails on a large scale, trust in the accuracy and fairness of the entire financial system just evaporates overnight.
Understanding this fundamental distinction is really your first step to mastering global custody and how modern markets actually function. Whether it's a massive omnibus pool operating in London or a street name account in New York, knowing who holds the title versus who holds the profit is literally what keeps the global gears of finance turning smoothly. It is a completely invisible yet profoundly essential architecture of trust.
And I'm going to leave you with this final provocative thought to ponder. If the entire global economy relies purely on perfectly matching internal ledgers to external registers every single day, without fail, just how fragile is this infrastructure of trust? Thanks for joining me for this explainer, and keep questioning the mechanics of the world around you.